Hello traders, in this video I will talk about one of the most important components of risk management, which is position sizing. All information provided by Trade Out Loud in this presentation is for educational purpose only and should not be construed as an investment advice regarding the purchase or sale of securities, options, futures, forex, or any instrument of any kind. My name is Anka Metcalf, and I'm the CEO and founder of TradeOutLoud.com, which is a trading education firm that is specialized in educating individuals how to day trade, swing trade, and actively invest in the futures and the equities markets. I have been doing this professionally for over 20 years. I specialize in trading the open of the New York trading session. I trade futures, and I am usually done by 11:30 or even way before that. And I swing trade. I love to swing trade stocks and ETFs. I have been, like I said, a professional independent trader for more than 20 years. And prior to becoming a professional independent trader, I come with 10 plus years in investment banking. I'm also the designer of an institutional proprietary trading system that is based on price support resistance, specific trigger times for the New York trading session, specific price zones, 4 specific price zones where institutional traders find levels where they can scale in and out of the trades. Chart synchronicity and divergency, and a strict set of rules that enable myself and my traders to identify trades with ease. Now, the most important part of money management is definitely position sizing, like I was mentioning before. And aside from position sizing, there is also the component of managing your trade. That is a topic for a different presentation, but definitely if the trade starts working for you, it is a topic where you learn how to handle your trade as it's going into targets, because obviously if the trade is not working for you, you should be taking your stop. Here's my agenda for this presentation. Why position sizing is key to consistency, how to determine your position size, determine your risk tolerance, and the importance of calculating your position size. These are some of the most important components. And of course, the feeling towards the trade should never determine your stop. Analyzing your trade in terms of the risk-reward ratio allows traders to focus on the most important aspect of trading, which is position sizing, which needs to be part of your money management plan and incorporated into your trading plan. So how much to allocate per each trade? If you risk too little, then guess what? You won't even make enough money to pay for your dinner. But if you risk too much and the trade is not working for you, then you can definitely blow up your account. Position sizing, though, will determine how many contracts or shares you're going to take the trade with in accordance to your account size and daily loss limit. Position sizing should be only determined by your account size and your personal risk tolerance. The success of the trade can only be considered if you take risk into consideration. Before taking the trade, the trader needs to evaluate the risk and the potential reward. If the risk is asymmetric, meaning that the distance between the entry and the target area is too tight, you should not be taking the trade. Therefore, the trade is asymmetric. You should definitely wait for another trade to line up. However, there is also trades that have pretty good risk. And for that to happen that is happening especially when the trade has the potential to provide at least 2 or 3 Rs going into your target. So that means that it has a tradable void, and it accommodates further price action to travel into that specific bubble. Before initiating a trade, according to your trading plan, traders need to determine the risk for the trade and the potential reward before you actually push the buy or the sell button. But how do you do that? Well, technical patterns will determine that. Technical patterns will determine your entries based on your strategy, your stop, your targets, your risk, and the reward. These are the most important components of your trade. The success of the trade can only be measured in terms of risk. Determining your risk and risk tolerance. Here are some of the most important components. Risk is correlated to your account size. So again, you're looking at your account size, you take a piece of paper, you write it down, and you say, hey, what kind of trader am I? Am I a trader that is going to risk 1%, 2%, or 3%? If you're a more astute trader, you could go ahead and go for the 3%. If you're a beginner trader, you could actually go even less than 1% per trade. That will allow you to use more capital in the long run. So now that we have the set amount, the risk per trade, we need to figure out how many contracts or shares to take for each trade, right? So another very important element is deciding how many trades you will take per day if you're, let's say, a day trader, or even if you're a swing trader, right? Because if you're a day trader, you should allow yourself at least 3 to 5 trades a day. If you're a swing trader, you should allow yourself maybe 4, even 7 trades within a week. But that doesn't necessarily mean that you're going to be taking all those trades, because if the environment is not right, you should not be taking those trades. Let's talk a little bit about risk tolerance. There are a lot of individuals out there that have bigger account sizes. So how do they handle that? Because if you're risking 2% on a trade in a $100,000 account, that's $2,000, let's say, per trade. That adds up to, let's say, $6,000 of risk per day if you're allocating 3 trades per day. So that means that if you're having a bad week, you're blowing $30,000 of your account. But consider this. If you're just beginning trading, it's better off to start small. So even if you have a big trading account, you could actually start risking less than 1%, which, let's say in this case, would be $500. That's a little bit more tolerable, because when you decide to trade, to day trade, to swing trade, remember that when you're losing in a trade, it's not a pleasant feeling. But it's so much easier if you're using the R units, and if you're allocating the same risk amount on all the trades, it's so much easier to make up for the trades. So risk tolerance can be different than your textbook risk per trade, because everybody out there is telling you, hey, risk 2% or 3%. But if you have that hot potato feeling in your hand, you could definitely go and trade less. Traders should be super comfortable with your position sizing, because every time you start your trading day, you should have a really good relationship with your money and say, hey, if I lose this kind of money, it's not going to be devastating for myself, right? So in case you lose that amount per day, which can mean 3 to 5 trades, you should not be devastated for any trading account. Too big and you could mismanage, too big and you could take profits way too early and exit right at the turnaround point. For example, if you have, let's say, a 500,000 account size, right? And let's say your position sizing is 1%, then your risk per trade should be $5,000. This is the only invariable, because the distance between the entry and the stop is going to vary with each trade. This should be in your trading plan. Now, size will not change unless the account has grown with at least 40 to 50%, and then you can recalculate your position size. The conviction for the trade has nothing to do with position sizing. So shouldn't have any kind of gut feeling. The only variable side is the distance between the entry and the stop. So I'm going to share an example with you right now. For example, we have the mini S&P here. This is a pullback buy. You can see that we have a pullback. We have the rotation that is happening. This is the entry point. This is the stop point. I like to select my entries into the rotational point to confirm that the price action is ready to take out the red, and I like to put my stop below the pivots. So this is the only invariable. It's going to be different for all the trades. For example, this is a wider stop here, but if I would have taken the trade over here, this would have been a really tighter stop. For example, here, if I wanted to take the trade, it would have been, again, a tighter stop. So for this example purpose, the entry here was 36.45. The stop was 36.20. Obviously, you calculate the targets above. So therefore, the difference between the entry and the stop is no more than 20 points. So that means that you're risking 20 points. Now, your obligation right now is to calculate how much does that 20-point risk, how many contracts you could take with that. So position sizing math for futures is a bit different because of the different size contract. And this is why most of the traders never position size, because they either don't get it or just get very lazy. The big misconception about futures is that if you have a certain account size, hey, you could just take 1 or 2 contracts constantly. And this is so wrong. This is amateur hour. This is a little table right here that is going to give you exactly an idea of what I'm talking about. So for example, if you have a 20-point stop into the mini S&P, and if you have a position size of, let's say, $500, you could actually take 2 contracts. So let's get into our example, the $500,000 contract, you're risking 1%, then $5,000 per trade. Perfect example here. If I'm risking $5,000 on this trade, I could definitely trade it with 5 full-size contracts. Here's an example from my portfolio. This is one of the difficult periods from trading from last year when the market was sideways. Now we're crossing. Now when I'm doing the reporting is February 9, 2023, and the market is still ranging. This is my win-risk ratio. This is my average per day. And these are a lot of factors you can pause to look a little bit in depth. But as you can see here, so this is from my account, as you can see here, this is literally the size that I'm trading. 5 contracts here, 10 here, 3 here, 2 here, 5 here, 8 here, 5 here, and so on. So you can see that the only variable is the number of contracts that I'm taking and not the other way around. So you can see it right here. For example, in S&P here, I'm taking the trade with 10 contracts. I'm taking the trade with 6 contracts. I'm taking the trade here with 8 contracts and 8 contracts here. So this is the number that literally varies. Here's an example of the performance portfolio that I provided my traders. This is real time, and this is the realized per contract. All right, this is another example. For example, this is the stock. This is the FDX in this example, and this is a rotation that is in progress. This is a steep pullback, and we're waiting for a rotation. We're waiting for the price to take out the prior high, put the stop below the prior low. So what happened here is, take a look. See, it delivered really well. This is a trade that actually we took. So the difference between the entry and the stop should be your risk level, and then your position size to see how many shares you have, you can take. Here's another example with another stock, and you have multiple buying opportunities. You have the pullback and the rotation here, you have the pullback and the rotation here, and so on. So you can see that the only difference right here is that I'm going to be applying the same risk on all of my trades, but in risk size. However, the distance between the entry and the stop is going to be different from all of these pullbacks. If you guys want to trade with us, I do run 2 programs. I run the Stock Swing Trader, where I call swing trades. You have access to the performance portfolio. You also have access to a share size calculator that I provide for my traders, amongst other elements that I find. Or you can join us in the Futures Trading Room. You find the links on the bottom of this page, where also I provide a position size calculator as well. Thank you so much, and I'm looking forward to seeing you guys in the trading room and in the Stock Swing Trader program.